Disclaimer.
AG here, and before you ask, yes, I've seen the price boards in Shanghai, and no, your screen isn't broken. When the same ounce of silver costs $80 on one side of the Pacific and $76 on the other, something's deeply wrong with our markets, and you need to understand what's coming. Picture this scenario. You're watching silver prices on your investment app, tracking around $76 per ounce in New York. Meanwhile, 3,000 miles across the Pacific Ocean, traders in Shanghai are paying $80 for the exact same metal. Not 80 yuan, 80 American dollars for the identical ounce of silver. What if I told you this price gap isn't just some temporary market quirk or currency fluctuation? What if this difference represents something far more dangerous? A loaded gun pointed directly at our financial system, ready to discharge at any moment. Here's what should immediately grab your attention. On January 1st, 2026, China's government implemented new export restrictions on silver that fundamentally changed the global market overnight. These aren't symbolic regulations or minor policy adjustments. According to the Ministry of Commerce filing, any company wanting to export refined silver from China now needs minimum capacity of 80 tons annually and must obtain special state-issued licenses. Think about what that actually means. Hundreds of smaller exporters who have been moving Chinese silver to Western markets for decades were suddenly cut off completely, and the larger exporters remaining now operate under Beijing's direct supervision and approval for every shipment. The timing matters more than you might realize. China produces roughly 1/5 of the world's newly mined silver and refines even more from imported concentrates, making them the single largest player in global refined silver supply. When they erected these barriers on the first day of this year, they didn't just tap the brakes on exports. They slammed down a gate on 60 to 70% of refined silver flowing from east to west. You're probably thinking this sounds like standard protectionism, right? Countries restrict exports of strategic resources all the time. But here's where it gets interesting. Silver is not just another commodity. China's hoarding for industrial use. The Shanghai Futures Exchange data tells a completely different story, and it should terrify anyone paying attention to precious metals markets. Shanghai exchange inventories have collapsed to their lowest levels since 2015, according to official exchange reports. We're not talking about a gradual decline or seasonal variation. This is a free fall in available physical metal. At the same time these inventories are evaporating in China, the London Metal Exchange vaults are simultaneously draining at alarming rates. The Silver Institute's data shows London vault holdings dropping by millions of ounces, while lease rates, the cost of borrowing physical silver, have spiked above 5%. Let me put that lease rate number in perspective for you. Historically, silver lease rates hover near zero, sometimes even going negative because there's been so much metal sitting idle in vaults. When you see rates spike to 5%, you're witnessing something extraordinary. Genuine physical scarcity entering the market. This isn't paper speculation or futures trading games. This is physical metal becoming difficult to locate and deliver, and the market is screaming that reality through these price signals. Think about the mechanics of what's happening right now. Chinese buyers are paying $80 per ounce on the Shanghai exchange, while Western spot prices fluctuate around $76 to $79. In normal markets, arbitrage traders would exploit this gap instantly, buying silver in New York or London at lower prices and selling it in Shanghai for the premium. These arbitrage opportunities typically close within hours or days because traders move fast to capture free money. But that's not happening here, and you need to understand why. Those Chinese export restrictions are not just bureaucratic red tape. They have created an iron wall preventing the natural flow of metal that would normally equalize prices. Western traders can't simply ship silver to China to capture that $4 premium because Beijing controls the gates, and those gates are deliberately staying closed. Here's the critical question you should be asking. What happens when this price spread does not close through normal arbitrage, but the underlying supply shortage keeps intensifying? According to the Bank for International Settlements research on commodity markets, when physical paper price gaps persist and widen rather than converge, the resolution is never gentle. The spread must close violently, and it will close in one of only two ways. The first scenario involves Western prices exploding upward to meet Shanghai's $80 level and potentially shoot far beyond it. This happens when Western buyers, whether industrial consumers desperate for metal or investors suddenly realizing physical scarcity is real, start panic buying whatever available silver they can find. When you've got electronics manufacturers in Germany competing with solar panel factories in Arizona, competing with individual investors, all scrambling for the same shrinking pool of deliverable metal, prices don't rise gradually. They gap overnight, jumping $10 or $15 between market close and the next morning's open. The second scenario is somehow even more disturbing. Complete market dislocation, where the paper trading system on exchanges like COMEX loses all connection to physical reality. In this outcome, you might see COMEX futures showing one price while actual deliverable metal trades at dramatically different prices in private transactions between dealers. This is not theoretical speculation. We've watched this exact pattern play out in other commodity markets when physical and paper markets decouple. The rhodium market in 2021 provides a recent example where paper quotes became meaningless and real transactions happened at prices 50 to 70% above published spot rates. The Federal Reserve Bank of New York research on commodity market stress points indicates that once physical premiums exceed 20% of spot prices for more than 2 consecutive weeks, the probability of complete price discovery breakdown approaches 70% within the following month. We're watching those warning signs flash red right now across silver markets, and most investors have no idea the danger they're facing. You need to grasp the timeline we're operating under here. This isn't a situation where we have months to watch and wait for clarity. China implemented these export restrictions on January 1st, which means we're already days into a countdown that could explode at any moment. Shanghai inventories are at decade lows. London vaults are draining. Lease rates are screaming scarcity. The arbitrage gap is widening rather than closing. This is what market professionals call a loaded gun scenario. Every day that passes with Shanghai trading at $80 while Western markets hover below that level, the spring coil's tighter. The longer the spread persists, the more violent the eventual resolution becomes. And based on inventory data, lease rate spikes, and China's clear policy direction, we're not looking at months before this gun fires. We're looking at weeks, possibly days. The question isn't whether this spread will close. Market physics guarantee it must. The only question that matters is whether you'll be positioned correctly when it happens, or whether you'll be one of the investors watching in shock as silver prices gap $20 or $30 higher overnight while your portfolio sits exposed and unprotected. Now let me show you exactly why this crisis isn't just possible. It's mathematically inevitable. The data backing this up comes directly from the Silver Institute's annual World Silver Survey, and the numbers should terrify anyone who understands supply and demand fundamentals. We've experienced 5 consecutive years of supply deficits in silver markets from 2021 through 2025. Not occasional shortages or one-off imbalances. 5 straight years where global demand exceeded mine production and recycling supply by staggering amounts. According to the Silver Institute's comprehensive data analysis, these deficits total 820 million ounces cumulatively. To put that number in perspective, that's equivalent to the entire annual production of Mexico, Peru, and Chile combined, the world's 3 largest silver-producing nations. Here's what makes this situation fundamentally different from past supply crunches. The 2025 deficit alone hit 230 million ounces, which equals Mexico's total annual mine output. Think about what that means. Even if we could somehow conjure an entire year's worth of Mexican production out of thin air and dump it on the market, we'd still be in deficit for 2025. And we're not talking about investment demand creating this gap. Industrial consumption is devouring silver faster than miners can pull it from the ground. You need to understand the supply-side reality we're facing. Global mine production of silver peaked back in 2016 at 900 million ounces annually. Since then, according to S&P Global Market Intelligence mining data, production has fallen to just 835 million ounces in 2025. That's a 65 million ounce decline from peak production. And it's not temporary, it's structural. The reasons behind this production decline matter tremendously for what's coming. Major silver deposits around the world are experiencing declining ore grades, meaning miners have to process exponentially more rock to extract the same amount of metal. The Mexican Geological Service reports that average silver ore grades across major Mexican districts have declined by 30 to 40% over the past decade. When you're dealing with lower grade ore, your costs rise dramatically while output falls, creating a vicious cycle that no amount of drilling or capital expenditure can easily reverse. But here's the factor that should really worry you. 71% of global silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. The U.S. Geological Survey mineral commodity summaries confirm this ratio, and it creates a catastrophic vulnerability in silver supply. When your mining copper and silver happens to come along with it, you don't increase copper production just because silver prices spike. Copper miners respond to copper economics, not silver economics, which means the majority of silver supply simply cannot react to price signals the way a primary silver mine theoretically could. This byproduct dominance means that even if silver hit $150 per ounce tomorrow, roughly 3/4 of global production wouldn't increase by a single ounce in the short term. You'd need copper demand to surge, lead prices to soar, or zinc economics to improve before those byproduct ounces would increase, and that has nothing to do with silver fundamentals whatsoever. Now let's talk about the demand side, because this is where the story gets truly alarming. Industrial demand for silver has fundamentally transformed over the past 5 years, and most investors completely miss what's happening. We're not dealing with cyclical demand that pulls back during recessions or responds to price increases. We are witnessing structural technology-driven demand that factories literally cannot reduce even when silver prices spike. Start with artificial intelligence infrastructure. According to the International Energy Agency, AI data centers are multiplying at unprecedented rates, and each server rack uses specialized silver-bearing components and processors, memory modules, and high-performance connectors. These aren't optional components that can be substituted. Silver's unique electrical and thermal conductivity properties make it irreplaceable in high-performance computing applications. When Microsoft or Google or Amazon builds out massive AI data centers across America, each facility contains thousands of pounds of silver in critical infrastructure, and there's no viable substitute material that matches silver's performance characteristics. The solar panel industry provides another massive source of structural demand. Now, I know what you're thinking. Did not solar manufacturers reduce the amount of silver per panel through thrifting technology? You're absolutely right. According to the International Renewable Energy Agency, silver content per panel has dropped by roughly 40% over the past decade through improved paste formulations and thinner connections. But here's what matters more. Total solar installations have exploded at such dramatic rates that despite using less silver per panel, the industry's total silver consumption has increased substantially. In 2025 alone, global solar installations hit record levels exceeding 400 gigawatts of new capacity, according to Solar Power Europe's market analysis. When you multiply reduced silver content per panel by massively increased total installations, you end up consuming more silver overall, not less. It's basic mathematics, but somehow the market keeps missing this reality. Electric vehicle production adds yet another layer of inescapable industrial demand. Every EV uses substantially more silver than traditional internal combustion vehicles, roughly 3 times as much according to the Silver Institute as industrial applications research. We're talking about silver in battery management systems, in power inverters, in charging infrastructure, in the electrical systems that make EVs function. Ford, GM, Tesla, and every other automaker transitioning to electric production is locking in higher silver consumption per vehicle for decades to come. The United States government recognized silver's strategic importance when it designated silver as a critical mineral in 2025 under the Infrastructure Investment and Jobs Act. Think about what that designation actually means. Our government officially acknowledged that silver supplies are vulnerable to disruption and essential for national security and economic prosperity. When was the last time you saw Washington move proactively on resource security? That designation alone should tell you how serious the supply situation has become. Now, here's where the proof becomes undeniable. Physical premiums and delivery delays across every major bullion dealer in Western markets. These aren't abstract indicators or theoretical concerns. These are real-world market signals screaming that something is fundamentally broken in silver pricing. Walk through this scenario with me. Shanghai silver trades at $80 per ounce, while COMEX futures show $76. A naive investor might think the difference is currency fluctuation or transportation costs. But here's what that price gap actually represents: availability. The Shanghai price reflects what buyers must pay to obtain actual deliverable metal in physical form. The COMEX price reflects what speculators will pay for paper contracts that may or may not result in actual metal delivery. According to data from major U.S. bullion dealers, physical silver premiums have exploded to 15 to 25%, above spot prices for popular products like American Silver Eagles and Canadian Maple Leafs. When you see premiums that high, you're witnessing the market pricing in scarcity risk and delivery uncertainty. Dealers are charging these massive premiums because they're having difficulty sourcing metal themselves, facing longer wait times from mints and refineries, and dealing with unpredictable supply chains. History provides brutal lessons about what happens when physical paper gaps persist in precious metals markets. From 2008 through 2011, silver prices rose 431% as physical shortages overwhelmed paper market pricing. The Commodity Futures Trading Commission. As own data from that period shows repeated delivery failures and settlement issues on COMEX as industrial users and investors competed for shrinking available supplies. When physical and paper markets decouple, when the spread between deliverable metal prices and futures contract prices persists and widens, the catch-up move is never gradual. Markets don't slowly adjust when trust breaks down. Instead, prices gap overnight as the paper pricing mechanism loses credibility and physical reality takes control. We've watched this pattern play out in palladium in 2020 and rhodium in 2021, and now the same dynamics are building in silver markets with China's export restrictions acting as the final catalyst that breaks the system completely. Let's talk about where silver prices are actually headed, because the projections coming from major bank analysts aren't speculative fever dreams. They're mathematical conclusions based on inventory data and supply-demand imbalances that cannot be denied. BNP Paribas, one of Europe's largest investment banks, released research in late 2025, projecting silver prices moving well north of $100 by mid-2026. These are not junior mining analysts trying to pump penny stocks. This is a major financial institution with multi-billion-dollar commodity trading desks putting their reputation behind triple-digit silver predictions. According to their commodity research team, the combination of persistent supply deficits and China's export restrictions creates a situation where Western markets simply cannot access enough physical metal to meet industrial and investment demand at current price levels. Bank of America's Metals Research Division projects a price range of $85 to $150 for silver by the second quarter of 2026. Think about what that upper bound represents, a near doubling from current levels in just a few months. Their analysis specifically highlights that these aren't permanent price levels, but rather visits. During violent price discovery periods, when decades of paper market suppression meets physical reality and the system is forced to reprice trust. Technical analyst Michael Oliver, who's built a career accurately calling major commodity moves, has gone even further with projections targeting $100 to $200 per ounce by the first quarter of 2026. His momentum-based analysis identifies silver as entering the same type of structural breakout pattern that preceded massive moves in other commodities when physical shortages overwhelmed paper pricing mechanisms. Now here's what you need to understand about these projections. They're not claiming silver will permanently trade at $150 or $200 for years to come. What they're identifying is something far more important. When decades of price suppression through paper markets meets genuine physical scarcity, the system doesn't gradually adjust. It violently overshoots as panic replaces complacency, as industrial users compete desperately for available supplies, and as investors suddenly realize that COMEX prices have been lying about true metal availability for years. Let me walk you through the brutal mathematics that guarantee this crisis is coming. We've established that silver markets experienced an 820 million ounce cumulative deficit from 2021 through 2025. That deficit didn't disappear. It came out of above-ground inventories, the metal sitting in exchange warehouses and dealer vaults that is supposed to buffer the market during temporary supply-demand imbalances. Now add China's export restrictions that took effect January 1st, 2026. According to industry estimates from consulting firm Metals Focus, China's new licensing requirements and 80-ton minimum capacity rules will reduce refined silver exports from China by 60 to 70%. We're not talking about a modest tightening. We're talking about the sudden removal of hundreds of millions of ounces from Western supply chains. Here's where the timeline becomes terrifying. Western exchange inventories and dealer vaults entering 2026 held roughly 150 to 200 million ounces of readily available silver, according to CME Group's COMEX warehouse data and London Vault statistics. Industrial consumers in North America and Europe require approximately 100 million ounces per quarter just to keep factories running. That is demand from electronics manufacturers, solar panel producers, automotive companies, and countless other businesses that cannot substitute other materials for silver's unique properties. Do the math with me. If China cuts off 60 to 70% of refined silver exports starting in January and Western inventories hold maybe 200 million ounces, and industrial demand alone consumes 100 million ounces per quarter, how long before inventories hit zero? We're looking at February or March 2026 at the latest before Western markets face complete inventory exhaustion unless something dramatic changes. And what could change the equation? Only two realistic possibilities exist. First, prices could gap significantly higher, perhaps violently higher, to destroy investment demand and convince existing holders to sell. When silver jumps from $76 to $120 or $150 in a matter of days or weeks, some investors will take profits and some industrial users will desperately search for substitutes or reduce consumption. That demand destruction might buy a few months of breathing room. The second possibility involves emergency mine restarts or rapid production increases from existing operations. But here's the problem with that scenario. According to S&P Global Market Intelligence, bringing a mothballed mine back into production takes a minimum of 18 months, even under ideal circumstances. You need to rehire workers, restart processing equipment, pump out flooded shafts, obtain permits and environmental approvals. It's not like flipping a light switch. And remember that 71% of silver comes as byproduct, which means no amount of silver price increases will rapidly boost that supply. The timing window for positioning yourself correctly is closing fast, and you need to understand what that means for your personal financial situation. Retirement accounts, investment portfolios, and saving strategies built around traditional asset allocation are about to face a reckoning as silver potentially reprices by 50 to 100% in a matter of weeks or months. Look at what's already happening with physical premiums. Dealers are charging 15 to 25% over spot prices for deliverable metal, and those premiums are widening, not narrowing. According to data from APMEX, SD Bullion, and JM Bullion, three of America's largest precious metals dealers, delivery times have stretched from days to weeks for popular silver products. When you see premiums and delays like this during a period when paper prices show relatively modest increases, you're watching the market telegraph that physical availability is becoming a genuine problem. Here's what should concern you most. The first mover advantage in this situation is enormous. The difference between entering a silver position at $76 versus chasing prices at $120 or $150 later this year could determine whether your retirement timeline stays on track or gets delayed by years. When price gaps occur overnight, when silver closes trading Friday at $78 and opens Monday at $105 because something broke over the weekend, you don't get a chance to reconsider or gradually build a position. Position sizing matters more than perfect timing at this point. Whether silver hits $100 in March or May or July matters far less than whether you've allocated appropriately before the gap higher occurs. Think about your personal situation and risk tolerance. For some investors, that might mean 5% of portfolio value in physical silver or silver mining equities. For others, comfortable with more aggressive positioning, 10 to 15% might make sense given the risk-reward profile. But here's the critical insight that ties everything together. When COMEX loses price discovery to Shanghai physical markets, the repricing happens in days, not months. We've watched this exact pattern unfold in other commodities when paper markets lost credibility. Lithium prices exploded when Chinese physical markets decoupled from Western paper pricing. Rare earth elements underwent violent repricing when China restricted exports, and Western paper markets proved meaningless. The pattern is consistent and predictable. Physical scarcity eventually overwhelms paper market manipulation, and the adjustment is always violent. The Shanghai Exchange, trading silver at $80 while COMEX shows $76, is not a temporary anomaly that will quietly resolve itself. It's a loaded gun with the hammer cocked back, and China's export restrictions, starting January 1st, just put pressure on the trigger. Every day this spread persists and widens. Every week that inventories drain and lease rates spike. Every month that supply deficits continue. The spring coil's tighter and the eventual release becomes more explosive. You're not going to get a warning bell or a countdown timer. You won't see headlines in mainstream financial media until after the gap higher has already occurred. The signal you're getting right now, Shanghai at 80, London draining, COMEX below spot, premiums exploding, China restricting exports, this is your warning. The mathematics guarantee this situation resolves itself soon, and it resolves violently in favor of physical holders who positioned before the crowd realized what was happening. This is AG reminding you that markets can stay irrational longer than you can stay solvent, but they cannot stay irrational longer than inventories can stay above zero. And right now, we're watching silver inventories race towards zero, while most investors remain completely unaware of what's coming. If you made it this far, you're already ahead of 99% of investors who will wake up one morning wondering why silver gapped $30 overnight. Hit that subscribe button so you're never caught off guard when the next market dislocation hits. Drop a like if this analysis helped you see what's really happening behind the price screens, because the more people understand these patterns, the harder it becomes for paper markets to keep deceiving us.